People have been trying to imply that what he did was morally wrong, and I won't get into that argument, but I'm not sure he did anything that was legally wrong. He was following the tax code because Trump, as it happens, is a general partner. Depreciation is not a US concept. You can live in other countries and get depreciation. The key is that anyone who is interested in learning how to get depreciation on active income should read on ChatGPT the definition of real estate professional. You'd be surprised that you can hold down a full-time job and still get to a real estate professional status.
I'm your host, founder and CEO of ZANA Investments, Tim Little. And on today's show, we have with us a legend in the game, the mad scientist of multifamily himself, Neal Bawa. Neal is the CEO and founder at UGrow and Grow Capitus, commercial real estate investment companies that use cutting-edge real estate analytics technology to source and acquire or build large commercial properties across the U.S. He has a current portfolio of over 4,800 units with an assets under management value of over $1 billion. Neal, welcome to the show.
Tim, thanks for having me on the show. It's great to be here.
Yeah, and it is great to have you. I'm excited to get into it. But first, I gave everyone a high level overview of your background. But on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Got there by accident. In 2003, I was running a technology company with hundreds of employees, and my boss decided that he did not want to rent a new campus and asked me to be involved together with him to build a new campus. So on July 4th, 2004, we opened a custom campus that we had pretty much built from scratch. And so I got into real estate in reverse. Most people do a fix a flip or they do a standard single family rental. I ended up building a 27,000 square foot building from scratch and worked really well. Massively elevated our business. We ended up building 6 more, no investors, no syndications, just us, and ended up getting incredible tax benefits. And I live in California, so I was paying 50% of my salary in taxes. And all of a sudden there were years where I was paying very little. And that turned me into somebody that truly understands the incredible benefits of real estate. And by the time I had enough, I'd saved a lot of taxes in 2004, 5, 6, 7, 8. I'd saved a bunch of money. And so in 2008, I got into single family, perfect timing, went out and bought a dozen plus properties and still own most of them. And then started my journey towards real estate data science. Data science is my major, computer science geek. And so I basically started that journey in 2009 when I was buying my single families. And that journey went on for about 5 years before I actually got into syndication in 2014. So now since 2014 or 15, 36 projects, 950 active investors, and about $1 billion assets under management, including the new construction projects. So it's been a long journey. So 2003 to 2023, 20 years, but only less than 10 years of that has been as a full-time real estate professional. The rest of it was simply me trying to reduce taxation and reduce the impact of taxifornia.
Yeah, and that totally makes sense. And obviously, we have listeners who are coming from a variety of backgrounds. Some are very savvy in the real estate industry, and others may be listening for the first time and really trying to understand what all the buzz is about with real estate. So, for those folks, can you talk about some of those tax benefits associated with real estate investing?
Of course, I think the biggest single benefit is depreciation. So you have the ability to buy an asset, and now this asset may be cash flowing. Maybe it's making 4%, 5%, 6% cash flow for you. But at the end of the year, you'll notice that what you're actually going to see is none of that cash flow is being credited towards your taxes because we call it return of capital. So we say we're returning capital, even though we're giving you money, and you can probably use that to run your life. And then, in addition to that, generally in the first couple of years, you see these massive paper losses, right? On a $100,000 investment, you might see 40, 50, $60,000 in paper losses due to both depreciation and a recent phenomenon called bonus depreciation. And what that allows you to do is to basically write it off against other passive income. If you can also write it off against active income if you or your spouse is actively involved in real estate, or if you're a syndicator. A lot of people that are listening to Tim's show are actually people that got into syndication because then they can be active in real estate. So once they're active in real estate, they can actually write off their other active income as opposed to just their passive income. So it's tremendously beneficial to invest passively in real estate, but it's even more beneficial to have it's your leg. I tell people, keep your day job at Google or Apple. Don't get rid of that. That's making you money, but get into syndication on an active basis where you're a GP or a small general partner in a deal, because then you have the ability to basically write off use depreciation against your active income. One other benefit that only accrues to general partners is that if I buy a $30 million building and it has a $5 million depreciation that I can take in year one, as a passive investor, I can only take depreciation to the extent of my investment. As a general partner, we get an additional 30% of that depreciation going towards us. So you can be a general partner with a very small investment in a property, let's call it $50,000, and get depreciation that might be equivalent to $500,000. So obviously, this is just an example and it all varies, but being a general partner is extremely powerful. Often people say, why didn't Trump pay taxes in those 15 years? The answer is, I'm not really sure he was doing anything wrong there. I think people have been trying to imply that what he did was morally wrong, and I won't get into that argument, but I'm not sure he did anything that was legally wrong. He was following the tax code because Trump, as it happens, is a general partner.
Yeah, and I think you brought up a bunch of great points there, but just to speak to the perception when people actually follow the tax code, a lot of times we hear the term tax loophole. It's not a loophole. They put these rules and regulations in place in order to incentivize behavior. They want people to invest in real estate and stuff like that. That's why those are in place. So it's not so much a loophole as you're just following the incentives that are put in place by the government. So it's just strange that when people take advantage of those incentives that were put there for a reason, it's people act like it's a gray area when it very much is not from a legal perspective, right? Like you said.
Yeah, it's also useful to know this, that depreciation is not a US concept. You can live in other countries and get depreciation. It's not some loophole that we came up with.
Yeah. And I think you talked about multiple different facets of depreciation. And I just want to hit on some of those real quick because uh, those more experienced among us do understand that you can still get that depreciation as a passive investor. And of course, as an active investor, once you get that real estate professional status, like you said, if you're filing jointly, like I'm going to, right? My wife has a regular W 2 job, works in tech. She's making six-figure income. I can help offset her income and put us in a lower taxable income as a couple because as a real estate professional, maybe I got tons of depreciation from those active deals that I'm doing. I think a lot of people just don't realize that as a passive investor, they can reap the benefits of depreciation because it's just hard for them to imagine if they haven't been exposed to it, right? Say they have one or two single family homes, they probably get it at that level, but they imagine that if they invest, like, why would they get depreciation passed down to them? But that's exactly what happens. So you're getting these distributions, $1,000, a couple $1,000, and then all of a sudden you get a K1 at the end of the year, which shows the gain or loss, and it's depreciation for say 10,000 when you only receive distribution for 2,000. I think that's surprising to a lot of, especially new passive investors.
I think so. And then I think the key is that anyone who is interested in learning how to get depreciation on active income should read on ChatGPT the definition of real estate professional. You'd be surprised that you can hold down a full-time job and still get to a real estate professional status. It's possible.
Yeah, absolutely. It's all just a matter of tracking your hours and, of course, consult your CPA.
Doing something with those hours, right? You can track, but I'll also actually do something with it.
Yep, absolutely. No, and you talked about those single family homes that you started in, and I think you said you started in 2009 with that, which, if that's the
Yeah.
case, yeah, that would have been ideal time to get into that market because you came in right after the bottom fell out. How was your timing? How did that help you in terms of the value that you saw increase in those over time? And at what point did you switch over to more the multifamily side as a focus for your investing?
Yeah, when people hear this, I bought my first single family home in late 2008, and then 2009, I just went into a buying frenzy. did that in 2010 as well. And then 11, 12, I was slowing down and shouldn't have slowed down, actually, should have kept going for another 3 or 4 years, but didn't know any better. A lot of people think, oh, Neal, you were just lucky. And I want to remind you, I want to remind everybody that this is why people are not successful in real estate, because they're like, if I was there in 2009, I would be buying everything. I want to remind you in 2009, we couldn't find, if we put 100 people into a room and said how many of them should be buying real estate, almost 100 would say, are you crazy? There was no one interested in buying real estate. Why would brand new properties that cost $250,000 to build be available for $100,000 if people were interested in buying real estate? You could literally walk into a city, a newer city, and you'd see this road, and every single home there was available for sale at 40% of its construction cost, and no one was buying these. So there's this very snooty feeling that investors have that, well, if we had started in 2008, of course, we would have made a lot of money. No, we were extreme contrarians. My family, I went and basically was stupid enough to tell my family that my data science was showing that this was the best time in history to buy single family rentals. I went and explained that for 30 minutes straight without letting anyone, without pausing at a family event. My family banned me from coming to family events. That was the end result of that. After 30 minutes of what I thought were phenomenally well-practiced math-driven arguments, I was told, don't show up at our events because other people are going to lose huge amounts of money because you're such an idiot. That's what was happening back then. So when people say, you got a great opportunity, no, we were shitting in our pants as we were going out there and making cash offers because everyone around us was telling us that we were the biggest idiots of all time. This is pretty normal. So today, again, multifamily properties have dropped 22% and are on their way to drop, I think, to 25, 26%. Larger properties have dropped about 22%, smaller properties maybe 18%. But if I was to ask 10 investors today, just a random set of 10 investors, are you investing in multifamily today? 9 would probably say no. Now, if I were to ask those same investors 18 to 24 months ago, 9 of them would say yes. And they were buying extraordinarily expensive properties with extraordinarily bullish assumptions 18 to 24 months ago. But because money was raining down on them, they weren't asking any questions. And today, when things are so much more reasonable, exit cap rates have gone into the 5s. That's great. Rent assumptions have gone into the 2s from the 3s and the 4s. People are paying 22 to 26% less than they were paying before. All of these things mean that this is an incredible time to buy multifamily. I just can't convince anybody of that because I don't think that investors are investors. I think that they're speculators and they like thinking of themselves as investors. It's like, I'm an investor. An investor invests in assets and they invest in a market cycle. Speculators put money down when things are good and stop putting money down when things are bad. So I think a vast majority of the people that ignored 2008 are also ignoring the opportunity today in multifamily for the same exact reason.
Yeah, no, that makes a whole lot of sense. And I think you're right to point out that the context matters, right? There's hindsight is always 2020, et cetera. But there's a lot of armchair quarterbacks out there who, to your point now, are saying, oh, I can't believe someone had bridge debt on these properties and have been more conservative. And it's yes, we were purchasing off whatever the current environment was. We try to underwrite to conservative standards always. And I think most syndicators will say that, but one cannot presume the Fed raising rates 10,000 points over the shortest amount of time in our history. And so it's really easy for people to sit back and say, yeah, it should have never done that deal. Yeah, it had way too much leverage. Well,
I think
bridge debt, but
on one side, I agree with you. On the other side, I completely disagree, Tim. So the part that I completely agree with is there wasn't any data point out there that the Fed funds rate would go from 0 at the beginning of late 2021 to 5.5 points today. There was no data. I can't find anybody that suggested that would happen. And not even mavericks, like people who are constantly gloom of doom, have suggested that. So from that perspective, I hold the entire industry to be blameless. But what was clear is that prices of properties were completely out of whack during that time frame. And so I'm going to do the mea culpa first. During that madness period, which basically started at the end of 2020 and went until maybe mid 2022, right? So 1.5 years, 6 or 7 quarters of madness. I think the best way to tell who is a good syndicator is to figure out how many properties they bought during that time frame. How many properties? My answer is 1.5. One of those I already owned. I simply wanted a more control, and my partners wanted to exit, so I basically exited those partners. I don't know if that one counts because it's a property that I've been running for years that I still own, but I'll count it as half a property. And then I bought one, but I was lucky with that property. In that property was in a very small market that most people would not like. It's called Killeen, Texas. It's a military market. But I was able to buy it for 5 cap because a lot of people don't want to buy military properties. And I said, instead of buying 3.5 cap in Austin, I can go 52 miles outside of Austin and buy 5 cap. And I'm pretty pleased with what happened there. So on the one side, I was able to buy a very rare 5 cap property on actuals. On the other side, it was a property that I already owned that I wanted to exit my partners. But other than that, during that 18-month time frame, when money was raining on us, I didn't buy anything. And so a lot of it really came from just this fear, somewhat irrational fear that something would go wrong because everything was so expensive. Something did go wrong and I didn't anticipate it. I didn't anticipate interest rates. But when you are priced for perfection, anything less than perfection hurts you, whatever it might be. So my rationale for staying out was this is priced for perfection, and perfection is just an impossible thing to achieve. So I think that there was a lot of irrational exuberance amongst syndicators in that 18-month time frame. I think a lot of it is reflected on the syndication industry primarily being formed in 2014 and later. The Jobs Act in 2012 democratized syndication, democratized investing. And by 2014, a lot of shops had formed. A lot of them have formed in the last 3 or 4 years, right? Syndicators, basically some big syndicators, their first property was purchased in 2016 or 17 or 18, right? We were buying properties in 2014, but I can't say that I've had more experience than that. I think that this is good for the industry. There's a humbling process that the industry has gone through in the last 12 months. We are not a bulletproof process that the industry has gone through. And I think that our millions of investors are going to benefit from it in the next 10 years from what has happened in the last 12 months. This is good for investors. But what's bad for investors is that they're using the past to predict the future. It's a very dumb mistake because clearly if in 2009 you wanted to use the past to predict the future, no one would have bought any single families. I bought dozens, right? Because obviously the last 24 months had been truly disastrous for pricing, right? So never use the past to predict the future. And by the way, in certain cases, it makes sense to look at a 10-year or a 5-year run. But if you look at the last year before that, why don't you look at the last 2 years? From the end of 2020 to the end of 2021, the United States experienced 15.5% hike in rents. Why not use that? You shouldn't, because the following year they came down to 5%. Today they're down to 1%. That averaging of 3 years still shows you that rents grow faster than inflation, because if you average the inflation over those 3 years, rents are higher. If you look at it in the last 12 months, rents are lower than inflation. And that's not the way to look at it. So averaging is useful but looking at just the experience of the last 18 months and only cherry picking the distress time frame and making your decisions based on that is not investing, that's speculation. And that's what's happening with investors. Every investor I see out there today is a reverse speculator. They're a scared speculator.
Yeah, and I think a big part of that being a speculator is that they don't have the time or desire to go into the details to really do the due diligence and dig into it. And as someone who focuses on data, what are some of the key data points or macro trends that you're seeing right now that people should pay more attention to? You talked about some of the trends leading up and how that's important context in and of itself so that it informs what you can predict will happen in the future. But what data points or macro trends are you seeing right now that people just need to pay more attention to?
I am not looking at inflation. 18 months ago, inflation was important. 9 months ago, inflation. Even 3 months ago, inflation. Today, anyone looking at inflation doesn't understand how market cycles work. Today, you need to look at disinflation or deflation. The industrial index has been now negative for 5 months and it's accelerating. Its negative status is accelerating. M2 or money supply has dropped by $1 trillion in the last 4 months. container shipping costs from China to the United States are now cheaper than they were in 2019, even if you don't adjust for inflation. Demand is dropping in the United States very quickly. We were at 400,000 jobs a month. We're now at 188. So today, the fear is, has the Fed overdone it? There's people who are still like inflation. You don't understand that when you see a 4.7% annualized number, the last 2 months have been 0.2 and 0.2. So if you just annualize the last 2 months, we're at 2.4, not 4.7. An annual number is good to look at in a normalized market. The last 12 and the last 24 months have not been normalized. If you look at the annual number for inflation in 24 months ago, now what normalizing is really good when you have a market that moves inside a narrow band. That's clearly not the case for the last 24 months. So while you're looking at the last 12 months, always know the number for the last 3, because now you're going to know what the trend is. The trend for the last 3 months for either headline inflation or core inflation is much lower than the newspapers are telling you. The real concern is that if inflation continues to trend at this rate, it could go below 0. That's called disinflation. Now, a few months of disinflation is awesome. More than a few months is something that the Fed has no tools to fight. Remember, all of the Federal Reserve's tools that they have in their book are basically designed around simply getting rid of inflation. So quantitative tightening, raising interest rates, all of these work, right? And you might say they can drop interest rates and that boosts inflation. Actually, no, it doesn't. Hiking interest rates kills inflation very quickly, and you've seen that 9.1 to 3 in just 12 months. But the reverse effect actually doesn't go quite that same way. Because if demand isn't there because you've killed it with high interest rates, then dropping interest rates doesn't instantly create that demand. It actually takes months or years for the demand to return. So it's not an on-off switch, just like hiking interest rates immediately cuts down inflation, and we've seen that. Hiking interest rates immediately increased cap rates, and we've seen that. The reverse doesn't actually quite happen as well. So here's my prediction. We are in early August or mid-August. My prediction is within the next 30 days, you will hear several Fed governors talk about disinflation or deflation, and that they're beginning to get worried. That's the trend that you should be watching today. And if you're watching inflation as a trend, you're late on that trend. So get your mind away from that.
Yeah, no, I'd be interested to see if that comes to fruition, because I agree with you that demand is dropping, but that's primarily a demand in goods. We've seen that demand for services has actually remained pretty robust, and it's impressive how much the American consumer is willing to put up with and keep spending despite their personal circumstances, as we see with credit card balances starting to rise again after they had gone down to their lowest levels in a while. So some of that was revenge spending on stuff like travel and everything else. But it seems on the services side, going out to restaurants, etc., people are still spending money. So I don't know how much that's going to dip. And then with as
I'm
long
going to
as
predict it's going to dip. I'm going to predict
all right.
because services inflation is tied to the percentage of the economy that owns jobs. Keep in mind that today's services economy is based on job gains from 3 or 4 months ago, which were at 400,000. So remember, in June, we added 209,000 jobs. In July, we added 187. 4 months before that, we were at 400,000 jobs. So the inflation that you're seeing in the services economy is not in real time. It's based on what happened 3 or 4 or 5 months ago, because there's a lag, right? So if you want to know what the services economy inflation looks like, you've got to extrapolate the jobs numbers from the last 2 months and move them forward another 3 months. And that's what's going to give you the true picture. And once jobs drop below 200,000 a month, which is basically equilibrium point, then you start to see some weakness in the services economy. And I believe that you will see that weakness in 90 days.
And so at that point, when the Fed chairs start to be concerned about this, do you think they will lower interest rates, given that it's one of the only levers that they have?
I have absolutely zero belief that the Fed either will or is forced to drop interest rates. I just think that they will reach an equilibrium point, and my belief is, I'm going to say this, I think the last hike in this cycle was in July or June, whichever one was the last one. I think July, they might have hiked it, or maybe it was June, but that was it. So here we are in August. I do not believe that the Fed will hike again. But keep in mind that the Fed doesn't have to hike to reduce inflation. We're at 550 basis points in the Fed funds rate, or 525, depending upon which number you use, because it's a range. That's enough. That's an enormous rock. That's 1,000 pounds on the chest of the economy. You don't have to keep adding hundreds more pounds. It's already there. It's already clearly showing an impact, in jobs. It's clearly showing an impact in inflation. The Fed will hold, and the Fed has really no incentive to drop interest rates until next year. I don't think that there's any movement in the interest rates or the Fed funds rate this year. You should start to see interest rates, which we call mortgage rates. So whether it's a mortgage rate for multifamily, you should start to see those start to drop by December, because mortgage rates are a forward-looking predictive interpretation of the Fed funds rate. So what we've seen in previous cycles is when the Fed pauses, mortgage rates drop because they're a forward-looking interpretation of the Fed funds rate. So you start seeing that drop maybe in December or January, and we'll see continuing drops. The bridge market, which obviously is highly predictive in nature, will start to come back maybe around July and August, because you'll start to see bridge rates go down. The bridge market probably wants to see the Fed drop a couple times before it starts to come back. So they're not going to be satisfied with a single drop. So again, the market will start to improve over the next 9 to 12 months, but it's a slow improvement process. I don't think 2025 is a ball-in year for real estate. I think it's a recovery year. Things will get better every month in 2025. I really think it's 2026 and possibly 2027 where you start to see some good trends in real estate. I never think we're going to see what happened in 2021 again. That was a bizarre data point that was tied to a bizarre event called COVID, and we will never see it again.